All right, Q&A from Sunday's Market Outlook, Sunday, October the 9th. First one, Fed versus Treasury yields. Are Treasuries just a weighted average of the forecast of future overnight Fed rates? And if so, is this because if a bank has a 2-year investment horizon for a pool of money, it can either deposit at other banks or the Fed, are at the Fed rate for 730 consecutive days at the prevailing rates, or they could invest in a 2-year Treasury. And therefore, to eliminate arbitrage, a 2-year Treasury converges to the weighted average of the expected path of overnight rates in the same period. It would sound like that would be logical, right? But an overnight rate has no risk. It is truly risk-free in the sense of any interest rate risk, because it is only for one day. You buy it at a discount, it matures at par, or if it's the the Fed window, it's a reverse repo where you give them money and they give you more the next day. There is no term premium in here. However, if I buy, let's draw a timeline. If I buy a 2-year security and interest rates change, it's going to change the market value of this security. So because the 2-year has risk, it has interest rate risk, I must be compensated for interest rate risk. The second part of it is it's 2 years. So it's a longer time period than just 1 year. So there is some kind of term premium in there. And maybe there is an inflation expectation built into the 2-year, but the higher the level of inflation, the higher the uncertainty associated with the level of inflation. So there would be an inflation uncertainty premium in there. So when we say that something is risk-free, we specifically mean it is default risk-free, but not risk-free in terms of interest rate risk, in other words, price risk, not interest rate free in terms of your break-even risk based on the inflation expectation. Will it come in higher or lower over that 2-year period? So typically you would have upward sloping curves. We have now, from the 2-year forward, a inverted yield curve, which means you have some kind of negative premiums going on in here. But it would not just be the overnight rate compounded for 730 days that equals the 2-year. It is a function of the overnight rate. The 2-year will reflect the overnight rate, but because the 2-year has some risk premiums associated with it, it will end up being more than just a simple compounding of the 730-day period. If it wasn't, if it was just the 730-day period compounded and that was the 2-year, why would you ever buy the 2-year? Why not just keep rolling your money day after day after day, because you'll get a floating rate? Why would you ever buy the 2-year, right? There has to be something to induce you to get in there, and since there is risk associated with the 2-year, there must be risk premiums. What do you make of the UN urging Fed to suspend rate hikes to stop a global recession? How do you interpret such information? Is this news worth considering, or is this just noise? Fed will do what they will do. Well, I don't know if I would call it news or noise as much as opinion. The UN has urged countries to get along. The UN has urged rich countries to help poor countries with world hunger. The UN has urged Russia to leave Ukraine. The UN does all sorts of things like that. Hey, why don't we all just get along? Why don't we put our guns down? Why don't we stop war? Why don't we do this? Why don't we do that? Well, the UN always does that kind of stuff, and it's like, you know, most people either leave the room or are sleeping or are paying attention to some other thing, and everybody gets up there and speaks, and you pretty much know what they're going to say depending on where they're from, and blah, 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 blah. So, no, I don't think it would have much effect on anything. If it has any kind of effect, it would have an effect on politicians in the U.S., and politicians on the U.S. would lean on the Fed. Trump did that to Powell in 2018, and Powell bended like a reed. So far, the Biden administration is staying off of Powell altogether because, well, you know, you got to get inflation down, and they know that if they leave the Fed with independence, if they use that term, well, look, the Fed has independence. Blame the Fed. They're trying to stay out of the fight and then just showing up to stick up for the little people, right? Oh, you're going to throw people out of work in a tight labor market. We're not throwing them out. We're not throwing anyone out of work, but, you know, politicians have to make hay, right? So no, I don't know that this is going to find its way to the Fed, because if it did find its way to the Fed, it would have to find its way to the Fed through some kind of political interference. The Fed's not going to bend to what the UN says. So this is nothing more than the UN saying, let's all get along, let's all stop wars, let's all fix world hunger, and blah, 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 blah. They've been doing it for how many years? And deaf ears, deaf ears. What does the Fed put mean? Fed stop raising the interest rate. Kind of. There's no real hard meaning for the Fed put. What it means is, the Fed has two mandates, right? One is to promote full employment, and the other one is called price stability. In other words, they want stable rates of increase in prices at around 2% per year. They do want inflation, but held down at around 2% per year over a long period of time. So it could be 1.5, 1.6, 2.2, 2.4, as long as it's hanging in around the 2%. That is their mandate. They have in the past stepped in when market prices are falling. They've stepped in to support asset prices by either cutting rates or buying bonds to squeeze money out of the bond market. And that's what's called the Fed put, is that if the market sinks too much, the Fed will step in to protect asset prices. So if we think that the Fed is going to stop worrying about goods and services prices and start worrying about asset prices, we say there is a Fed put in the market that we can be secure in holding the market long, because if it falls too far, the Fed will just step in and fix it. So the question is there a Fed put? And if there is a Fed put, how far down is the Fed put? There is a belief that the Fed put is gone and now it's a Fed call. In other words, if the market rises too much, if you have a call, you'll sell a call on the market. By selling a call, you're shorting the market. In other words, they'll do something to push the market down. So it's called a short call as opposed to a put. If corporations pass on new taxes to consumers, why won't they pass on new interest rate costs to consumers? They will. And won't corporations have to reduce expansion plans due to financing costs? It's not that they'd reduce financing plans or expansion plans due to financing costs. It's, let's say that you have a project that you want to invest in, and we'll call it Project A. And you've done your analysis of Project A. Maybe it's a new factory in a new city, and you've looked at, well, what is going to be the output of that factory? What can we sell the product for? What is the cost of producing that? And how much extra cash is generated. So you'll have a series of cash flows over a number of years, right? And then you'll have an investment. We'll put negative investment. And you'll add the present value, 1 plus r squared. And you add all these up, and you'll get something called a net present value. If it's greater than 0, you would invest because it adds value. In other words, it adds more cash on a present value basis than the cost of capital and the cost of the initial investment. What happens when interest rates go up is this term goes up, which makes the present value of the cash flows lower. So it lowers the net present value of the project. It doesn't always have to be that way. If interest rates are going up because the economy is booming, your cash flows would also increase at the same time. So you could have an increasing cost of capital and increasing cash flows that would still actually increase the net present value. But right now, in a slowdown or a slowing economy with a recession ahead, the forecast for these cash flows is actually lower. The discount rate is actually higher, which is turning otherwise net present value positive projects into net present value negative projects. So you would not invest in something that actually destroys wealth. So they are reducing their expansion plans, not only due to financing costs, but also the combination of higher financing costs and lower forecasted cash flows. Sounds like the world will have fewer goods at higher prices. Well, that is the danger of restricting investment. And when you restrict investment, you get that sort of thing. So if we know where investment is being restricted, on the recovery, there's going to be a shortage, which means that prices will still be firm on the recovery. So if we look at U.S. housing, there's an example where it's only going to become more expensive for developers to build spec houses. That means they build a bunch of houses without having buyers for them. They're called spec houses or speculation. Well, they don't build spec houses anymore because of the financing costs. Way too expensive. So that's not going to do anything to ease the housing shortage. going into this slowdown or recession or whatever it is. So on coming out of it, you're still going to have a massive shortage. You're not going to fix that particular problem. So that means there's going to be huge upswing on the way out. So if you you've got the logic right. So now your job is to find industries or sub-industries or sectors of the economy where the destruction of investment is significant enough such that when the recovery happens, there'll have been a period of underinvestment and very strong pricing power coming out of that. Next, what is your view on mortgage REITs at the time? Well, first thing we need to understand about mortgage REITs is they hold financial assets, mortgage-backed securities. As interest rates go up, the price of MBS goes down. This is the asset on their balance sheet, and they use leverage. Right, they use leverage, 7, 8, 9 times leverage, which means this drops a lot and you get an equity squeeze on that. However, they do use a lot of derivatives, interest rate swaps to when they buy their MBS to lock in that particular return, such as if interest rates go up, the derivative would pay off. If interest rates go down, well, now they have to pay the other side. So they can protect a lot of their value using interest rate swaps, but not perfectly. It's hard to predict. When they are holding MBS, every month they get interest plus principal, plus any prepayments, right? And then they can take these prepayments and they can invest it. The principal and prepayments go in another MBS security, which goes back on the balance sheet. Well, when interest rates go up, prepayments slow down, so they have less money for reinvestment. But they can take this the principal part and they can reinvest. Well, when they're reinvesting at MBS at the higher rates. Isn't that beautiful? They're buying them cheaper, investing at higher rates. But the market will overpunish them. Let's have a look at what Agency released the other day, because Agency was trading around $7.50 to $7.70 a share. And at these prices, I added some to my RRSP. Not much. I only added 600 shares. I was cautious. I was just adding slowly, and RRSPs only have a certain amount of money in there, and you can't just add more to your RRSP. So you're capital constrained in your RRSP, and I had enough dividends paid over the course of the year that I had some extra cash. I was just going to let it sit in cash for a while because it was paying well, but I had no choice. At that price, I had no choice. Let's see what their press release was. Okay, first there was concern in the market that they're going to have to cut their dividend. 12 cents a month, $1.44 a year. You got a $7.50 stock. You're going to have to cut your dividend. You can't have a 20% dividend, right? And then they released this on October 10th. And they announced today, Board of Directors declared a cash dividend of 12 cents per share of common stock. So they're not cutting their dividend. And then they said this: in light of recent market volatility, the company also announced preliminary estimates for certain financial measures for the third quarter. They felt it important enough to release this information, but nowhere in here does it say a dividend cut. You would think if there was a dividend cut in Q3 coming up and they're releasing preliminary estimates for certain financial measures, that's a big deal. If there's a dividend cut, you think they would have said something about it, but they didn't. You see, when they receive their interest payment, regardless of what the value of the security is. So let's say I buy a bond that's paying 4%. I'm going to get, let's say it's a $1,000 bond, I'm going to get $40 a year. Let's say interest rates rise and now my bond is only worth $900. Still going to get $40 a year. Let's say it falls to $800. Still going to get $40 a year. And then it's eventually going to rise to par. It'll be pulled to par as it comes closer and closer to maturity. So if I'm holding these things to maturity, if I'm not trading my book, if I'm investing in these things, I'm hedging out interest rate risk, I'm holding to maturity, I'm going to get $40 a year. I'm going to get my $40, period. So my cash flows are unaffected by the value of the assets that I have, but my net income will be affected by the value of the assets because I'll have gains and losses, unrealized gains and unrealized losses. I'm going to have to mark down my assets to market, which means I'm going to have an income statement loss, but I still get $40 a year. My cash flow is unaffected. Let's see what they say here. September 30th, tangible net book value per common share was estimated to be between 906 and 910 per share after deductions for common and preferred stock dividends declared through September 30th. So after you take those out, you still got 906 to 910 per share. This thing was trading at 750. So you had a 15% discount on this from book value. For the quarter ended September 30th, agency's comprehensive loss per common share was estimated between 199 and 203 per share. So you're going to have a loss. It is going to squeeze equity because your book value is dropping. It's an unrealized loss unless you actually sell those things. So that's why the book value is dropping. If interest rates started to plunge, these would suddenly turn into gains and book value per share would increase. For the quarter ended September 30th, agency's net spread and dollar roll income, this is a non-GAAP financial measure. Whenever you have any non-GAAP financial measure, you have to mention that it's non-GAAP. Was estimated to be between 82 and 86 cents per common share, excluding approximately 3 cents per common share of estimated catch-up premium amortized benefit. September 30th, agency had approximately $3.6 billion of cash. $3.6 billion of cash and unencumbered agency MBS, which includes approximately $0.8 billion at the company's captive broker-dealer Bethesda Securities and excludes unencumbered CRT. Well, we're getting into detail here. We could just skip all of this. Average at-risk leverage was approximately 8.1x. So that's what I mean. They use a lot of leverage, right? Let's see. Total investment portfolio was $61.5 billion, which includes approximately $17.9 billion of to-be-announced agency MBS, so they're still buying, and approximately $1.7 billion of credit risk transfer non-agency securities. Let's see, agency's hedge portfolio covered approximately 118% of the company's funding liabilities, and its duration gap was approximately 1 year. So it does have a duration gap, which is why we're seeing decreases in the book value per share, because they don't have the funding gap closed. This ended up being better results than what the market expected. So agency yesterday on the 11th had a great day. It was up, what, 11%. So as far as mortgage REITs, because they're holding mortgage securities, a couple of things happen. Their prices drop when interest rates go up and prepayments slow down. So you don't have you don't have as much as you would like to have to reinvest into new MBS at the higher rate. The amount of the principal you get is slowing down, which is normal. So that's what's going on there. My take on mortgage REITs is I think when you look at the group of them, it has been overdone. Like a lot has been priced in. And when rates stabilize and they start dropping, these things really accelerate to the upside. So probably more near the end of November, December, I'd probably be interested in looking at this space a little bit more seriously. But right now, without clarity on where we're going on rates, without seeing what's going to happen in November, without seeing the minutes this afternoon, I don't know how much higher is, which means I don't know how much lower is on these. At these bear market rallies, how do you pick your target price to sell calls? Why 380 and 370? If the job report turns out to be bad, market participants interpret a Fed pivot. The SPY would have went up instead of down on Friday. Yeah, it very well could have rallied on Friday. So let me answer this part first. This is a market of risk, not a market of return. So you have to understand risk, and you're putting bets out. You're taking on risk, and you expect to get paid for that risk. So you're always thinking about where the risk lies. Sure, it could have rallied. You can take a very naive approach and manage risk at the position level, which means every position you're trying to manage the risk of just that position, or you could manage risk at the portfolio level. So I have a portfolio that has a sizable long position within it. I am taking some positions in stocks and sectors that I think will do well as we come out of this. And once the Fed rate hikes stop and inflation starts subsiding and the market starts improving, those sectors will do well. Why jump in now? It's because I don't know when that's going to happen. So why not take a small position in those? So I do have long positions, but I know it's early. So I will offset those long positions with a short delta somewhere else. I don't know where I'll get my delta, but the index makes a lot of sense to get my delta. So as the market rises, this part of my portfolio goes up to a point where I think, well, you know, I don't know that there's much more upside involved. Let me lower some of the exposure that I have here. Now, if I did a naive approach, I'd be buying, selling, buying, selling, buying, selling. I prefer to buy, get the dividend yield, and as the market increases, sell. As the market decreases, buy them back. As the market increases, sell. Use the index options themselves to manage the risk at a portfolio level. So I multiply, well, I don't actually multiply it. My system gives me a statistic called dollar delta beta. And at any given time, I can see the full amount of exposure I have, whether it is positive or whether it is negative. If I'm uncertain about what's going on, I would like to get this as close to zero as I possibly can, so I sell calls. It depends on the delta that I'm trying to achieve. So the 380s might have had just enough delta that given the margin requirements, it was just enough to tweak this number to where I wanted it to be. And then depending on my conviction, the more convicted I am that this rally was, or whatever rally we have was nonsense, I will go deeper in the money, because why not get some delta exposure at the same time? Now I want to move into negative delta. I don't want to just make the premium on a 380. I want to get the in the money part as well, because as the index falls, well, through 370, if it's at 378 and you sell 370 calls, it's already $8 in the money. It's the same as shorting the index and covering $8 lower, except shorting the index has a borrow fee. Selling premium does not have a borrow fee, so it's cheaper to sell premium. So I pick levels that get my portfolio level statistic where I want it to be. I pick them based on how I feel, what my conviction is, what I'm trying to get done, and that really comes with experience. Just after a while, you just get a feel for it. Would you mind explaining the mechanics of central bank defending its currency? Why does it sell the U.S. Reserve? Okay, so let's take Bank of Canada. Canadian dollar has just been dropping against the U.S. The Bank of Canada might hold U.S. dollars, might hold euro, might hold pesos, depending on who its trading partners are. Well, the Canadian dollar is dropping specifically against the U.S. So if we look at the U.S. CAD pair, it was 130 a little while ago. Now we're up to what, 138? That's the US dollar getting stronger, by the way. So to change this, because it's this pair over here, you have to get the US weaker or the Canadian stronger. And you could sit around and say, how come no one is buying the Canadian? Well, the Bank of Canada says, we'll buy the Canadian. But to buy the Canadian, it's going to cost you US dollars to do it, because that is the pair. So you sell US dollars hoping to push the US down with all the selling, and you're buying Canadian hoping to push the Canadian value up with all the buying, and that is how you defend your currency. You eventually run out of US dollar reserves, though, and the Bank of Canada cannot print US dollars. It has to acquire them. What about diversification in equities with factors? Low vol, high dividend, value, performance are very different compared to spot. That is true. When the market is dropping, let's take staples, which is a nice industry. Staples will drop as well, but not as much. So let's say the market's down 20%, staples down 13%. You beat the market by 7%. The problem is, well, when do you get out? Remember, you bought it up here, right? So you're still down 13%. Yes, the market's down 20, but you're still down 13. If the market decides to turn around and go up, staples is the wrong thing to be in. At that point, you either want to be in the market or you want to be in consumer discretionary, because that has a much higher beta. Well, if the market turns up, consumer staples will turn up as well, but the market will outperform consumer staples. So by the time you wait to hit your break-even point, the market is way ahead and the market is beating you. Yes, you were beating the market for a while, but unless you're willing to take the loss and go into something else, well, you're sitting on a loss. So you have to learn how to move into safe positions and also take some kind of short position on the market at the same time to try to protect your portfolio value, the capital, so that when you do have to switch to another sector, you can do it quite easily. Now, if this were me and this were down, I still wouldn't take the loss. I would say I don't need to take the loss. The market is going to go up, so right away I'm going to sell puts over here. And the selling of these puts will help me buy calls over here. So the combination of the two should give me the same performance, if not a little bit better than the market. I will sell the puts on this one to buy calls on consumer discretionary. Or I will sell puts on this one and sell puts on this one, or I will just sell a put over here and buy a call over here and do what's called a risk reversal on consumer discretionary if I expected that that would be the performance. So if you are left with nothing but binary decisions, buy, sell, buy, sell, buy, sell, it's hard to preserve your capital in a bear market. Because in a bear market, almost everything goes down. Like 95% of stocks will go down. There really is nowhere to hide. So I said this in the Sunday's video, you have to move from where do I hide to how do I hide. What was the time to maturity when selling calls? 30 days? Yeah, you try to get close to 30. Sometimes the front month, like where we are right now, we're the 12th. These October's options expire next Friday. So what do you got in there? 10 days. Right, so I've already moved to November. Once you get to under 20 days, October, you know, the front month doesn't make any sense. You hop to the next one, so you're anywhere between, when you're hopping over, you're anywhere between, you know, 45 to 50 days. Makes a lot of sense to get into November. Still too far for December, unless I'm trying to get something specific done and I'm looking at December as being the month that I want to get it done in, or I'm trying to protect something for December. You know, I don't use it too often, but I will. But typically, once I get below 20 days, I typically start looking at the next one. Unless there's something that's going on before next Friday in the options that I want to get done. Like I want to buy something, but I don't want to pay the price. I'll sell an in-the-money put, and I'll do it for October. Because I want it to happen, and I want it to happen soon enough, but I want to buy it maybe 30 cents or 50 cents lower than what the current price happens to be. I'll use options to engineer a purchase. Okay, first question, and thank you for that, by the way. Do you think that in applied series there will be a space only for models using Excel? Yeah, I'm going to try to put something in the bottom-up one. It'll be a generic one. It'll be how to create a financial model in Excel that covers the three statements, the balance sheet, the income statement, the cash flow statement, and how you would model that. A lot of the numbers are related to each other. So, for instance, your cash flow statement really fills in on its own after you have the relationships defined. So you spend a lot of time defining relationships. And then you'll use historical data, and then you have to determine the relationships on the income statement. Are margins going to be stable? Are margins expanding? What is the growth rate that I should expect in sales? You have to account for the economy at the same time. Is there going to be a constant growth rate, an accelerating growth rate, a diminishing growth rate? So there's a lot of thinking about what goes on. I can't help you with that. So if you're looking at a particular company, you kind of have to come up with your own assumptions about what growth is going to look like. You can use company guidance as a starting point and say, well, I believe company guidance, I'll go with that, or you can change it. But you'll always put your assumptions separately. And then you model everything in your financial statement such that if you want to change your growth assumption, you change one cell. And your whole model changes because of that growth assumption, so then you could start to do sensitivity analysis. I can do a very generic one, but I can't help you with, you know, look, I'm looking at company XYZ. What's the growth rate in sales I should use? I don't know. You tell me. I know nothing about company XYZ. So I can do a generic one. But, you know, industry by industry, there are different things that you have to know about that industry to be able to do any forecasting. I can show you how to build a spreadsheet for it, but I can't show you how to forecast for it in those particular industries. It's just something that you kind of have to come by experience, but I will do something for that. Pertaining to the first section of money supply, if the market rallies, how does that create more credit? Also, do you pay for the earnings research from Refinitiv? For the data that I use for these videos, I try to use as many free sources as I possibly can, because the retail investor simply doesn't have the money to pay for a whole bunch of subscriptions. Some stuff you got to pay for, but you try to find subscriptions that might only cost you 30 or 40 bucks a month that have a wealth of information. Other stuff, especially economic releases, company releases, that's all free. If you want let's say you're following a company and you want the press release the same time everybody else gets it, go to their website under Investor Relations and subscribe. And every time they issue a press release, you'll get it in your inbox. The moment they release it, you'll get it right away. So you'll be at no disadvantage to the market. You'll get it immediately. If you are following some companies, go to their Investor Relations website and sign up for it. It's all free stuff. You know, you pay some places a subscription fee, and all they do is they get that stuff for free. They just aggregate it for you all in one place and give it to you. But if you subscribe to all of these different places, and you can, it's automatically sent to your inbox. Now, the next question is kind of the same. How do high bond prices and low yields encourage formation of more credit? Okay, well, let's say that, for example, mortgages. You go to the bank to get a mortgage. It's tied either to the 10-year. In some countries, like Canada, it's tied to the 5-year, or it may be tied to an MBS, a particular category of MBS. If prices are going up, yields are going down. So if the 5-year yield, the 10-year yield, and MBS yields are going down, mortgage rates are cheaper. If mortgage rates are cheaper, you're more willing to get a mortgage. Well, mortgage is credit, right? If the prices on the 5-year, the 10-year, and MBS are just dropping, that means the yields are increasing. And if the yields are increasing and we're basing our mortgage rate off the 5-year, it's the 5-year plus maybe 300 basis points, let's say. Well, the higher the 5-year goes, the higher mortgage rates are, the less likely you are to get a loan. It reduces credit. Now, that's just for houses. Think about cars. Think about all the stuff that you would normally buy, a home line of credit if you want to get a new kitchen done or a new driveway built, all that kind of stuff. Is there any particular reason why you deleted the yield curvature measure? Yeah, there wasn't a lot of information there. If we look at the factors, there are 3 factors for yield curves, right? There's levels. These are risk factors. There's levels, there's slope, and there's curvature. Levels is roughly about 80 to 85% of all the fixed income return comes from levels. Well, that's duration, right? And then slope is the second order effect. You might get 10 to 12%, and curvature is 3 to 4%. Here you're hunting for basis points, just basis points. You know, single-digit basis points. If you can figure out if curvature is going to be added or subtracted by overweighting or underweighting, but it's not an absolute strategy. These curvature trades are relative trades, as you're overweighting and underweighting certain parts to take advantage of changes in curvature. And most of the time when you're doing that, you're trying to be duration neutral so interest rates don't screw you up. Not a lot of information for the retail trader there in curvature. So that's why I decided that, you know, I'm not finding anything of value in this because it's such a small thing. It's if you are a fixed income portfolio manager that is you know, hunting and pecking for those basis points of outperformance, you might want to pay attention to curvature. But for the retail investor, you know, if you got your eye on duration, I think you're okay. Can I get your perspective on whether a retail trader investor can fully replace the 9-to-5 job salary with trading profits? My first question there would be, what is your capital? How much capital are you using? If you're using like 25,000, the answer is no, because if you're trying to generate a $75,000 a year income, you need 300% return. Not that it's impossible, just improbable to get done. I am an engineer by profession and want to have financial stability and free myself from the 9-to-5 job cycle. I blew up my few small accounts following Lambo and Ferrari guys on the internet. Mistake that I made. So let me say something about this. It's not so much that it's a mistake. Everybody does that when they first start out. The market is big and complicated, and it's hard to figure out. So any guidance is going to be helpful. And if there are people who are displaying a certain type of lifestyle, telling you what they're doing, you're not skeptical at first. You say, well, okay, well, I'll believe them. I'll do this, I'll do that. And you're outsourcing your thinking to someone else who does not have your best interests in mind. So, just be careful about listening to, if somebody is 23 years old, leaning on a Ferrari, telling you to buy something, ask yourself, does that make even the remotest bit of sense? That somebody who's been in the market for maybe 3 or 4 months, maybe even 6 months or a year, has got it all figured out. And most of the stuff you see in those videos, that's rented stuff. They don't own that stuff. They're just renting it to take a picture, to lean on it. So if they're leaning on a Ferrari and standing for a Ferrari, it's because they paid a guy $100 to take a 5-minute shot with his vehicle. That's it. But now going through the applied series, and I do believe I could not have gotten this precious knowledge from anyone else. So there, you can't, experience is important to have. You have to develop your own experience, but you also need education. And I know that formal education sort of gets dumped on today as being unnecessary. And I'll be the first to tell you that a 4-year degree from a university is easily a year of wasted time. That can easily be put into 3 years by getting rid of all of those courses they want you to take that are just not necessary, and courses that you could take later for human interest. But don't discount formal education, because what it is a collection, not of experience, but of things that have been found to be true. And that's what education really is. So if you combine experience plus education, you're doing well. So this is a difficult question to answer without knowing more, knowing the level of experience, the level of education, and the amount of capital that you have. But I'll tell you what my day looks like. Keystrokes, in other words, putting trades in or positions in, keystrokes, I might spend 3 to 5 minutes a day doing that. Actual trading. The rest of the day is learning more about stuff I don't know, is listening to other people talk and deciding whether or not they have anything to say that I don't already know, or if they have any validity. And the more experience and the more education you get, you can spot people who don't know what they're talking about a lot quicker. And it's mostly just learning. It's always learning, because there's so much you just don't know that you can never know, and you'll never know it all. And it really is just learning, even within an industry that I've been following for a long time, real estate, for example. If we look at certain spaces, there are new REITs evolving that I know nothing about, that I really, I look at and I think, well, I really should dive into that a little bit more to understand what's going on there. And there are major changes going on in some spaces. Some think, well, retail is the big one. Not so much. Office is the bigger one. Where there are changes going on, and not COVID-related changes, just changes in focus of where the money is going to be made over the next cycle. So you always have to keep up on this stuff. That's what your day is. So if you don't love learning this stuff, then you're not going to enjoy this. The picture of somebody sitting in front of a bank of screens, 6 screens, and buying this, selling that, doing this, doing that. No, there's no that's not reality. The reality is that you'll spend less than 10 minutes a day actually trading something on the screen, and the rest of the time looking at risk, looking at your exposure, thinking about, well, what if it goes to this point? What if it goes to that point? What are my exits? What's my break even here? How can I offset the risk factor that I have here with something else? And you're always just thinking about what the chessboard looks like. Yeah, that's a good analogy, I think. Is it possible? Yeah, it's possible if you have the right amount of capital and you love the game. It's not like, ugh, I don't want to read this report. I don't want to listen to this conference call. If it's like, ugh, I don't want to do this, and you find yourself listening to other people and outsourcing your thinking, then outsource it to a money manager and be done with it. And focus on your job and your cash flow, and put your cash flow into your portfolio. And at some point, the income from the portfolio will replace your job, as opposed to it becoming a job. But I do believe that even in the CFA program, there are many who enter the program and they exit the program saying, where's my job? How can I get a job? How can I get a job? Well, instead of being a job taker, just be a job maker, right? You can create your own job. You already have the knowledge, you have the skill. Set up a paper portfolio, create an IPS that you're going to live by. What are the rules you're going to trade by? What sector are you going to learn? What sector are you going to be an expert in? Start picking some stocks, do an analysis of the stocks. Yeah, it'll be a rookie to begin with, but as you go through it, you'll gain a little bit more experience. Your model will get a little bit better. Your portfolio will perform a little bit better. Once you start showing that you have some paper results, you can attract some investment capital. Once you attract investment capital and you show some results, you can attract a little bit more investment capital, and off you go. You don't have to rely on other people to give you a job. You can create your own job. But I get it. There is an economic reality to life. And sometimes building a business does require sacrifice and lean years that some people say, look, given the economic reality of life, I just can't do it. I can't get that done. Well, knowing that it only takes 3 to 5 minutes a day to set your trades, you could do that during lunchtime, right? And you can spend your evenings and weekends doing some research. And if you start small, in one tiny little corner with one little sub-industry, and you get to know that really, really well, after you know your little domain, you spread out a little bit more. Then you spread out a little bit more. Once you start down any pathway, any road, it's never just a straight road. It has branches all along the way. Every path in life that you start down. So if you think, finance, that looks great, I'm going to head down here. You have no idea where you're going to end up. But the point is, at least you're on the path, right? What are some key metrics to look at when doing an analysis on bond ETFs? The big one here is duration. What is the duration that you're taking on? In other words, look at the maturity of the bonds that it holds. And look at the risk of the bonds that it holds. Are they holding government bonds, or are they holding corporate bonds? If they're holding corporate bonds, are they holding mostly investment grade, or are they holding high yield? Or are they holding private credit? Less volatile, higher return, at least that's the thinking, because it's not subject, the private credit is not subject to market fluctuations. So there is interest rate risk, there is default risk, and there is illiquidity risk. Which risks do you want? What are your thoughts on the asset allocation barometer? I'm not too sure what that is, but okay. I'm building one for my portfolio to measure the overall direction we are headed to given certain indicators. So far, I've included indicators for leading index, shape of the yield curve, M2 money supply, year-over-year growth rate, valuations, trailing PE, sentiment indicators, CPI versus 5-year average CPI. So some of this is leaning into technical analysis when you're looking at growth rates over prior growth rates. PE, sentiment is big technical indicator. Then I rank some on given criteria. Would love some of your insights whether I should continue updating. It's just a waste of time. Here's the thing. I can't tell you the answer for that. So if you're looking at, let's say, healthcare stocks, and I'm looking at, let's say, data center REITs, There's a whole bunch of stuff that just doesn't matter to me that matters to you. And there's a bunch of, likewise the other way. Also, if we're both looking at those sectors, there's a bunch of stuff in the economy that we simply just don't care about. As far as a data center, I really don't care what phase of the business cycle that I'm in. Data centers are fairly stable. However, if I were investing in hotel REITs, well, then there's a whole bunch of economic indicators that suddenly became just really important to me that wouldn't be important to me if I were in biotech, for example, or if I were in data centers. So it's a function of what it is that you're looking at, and that could be very different than what I'm looking at. It's also a function of what you're trying to get done. As opposed to, I may have a different investment style and strategy than you, and I may be trying to get something different done over the next couple of months than you are. So there is no one answer for that. But here is the best answer I can give you. You must explore all of these things and accept or reject them. And I'll give you a story. When I first started in this game, I was absolutely overwhelmed with everything. There's all these different sectors, all these different industries, all these different companies, and I can spend all this time getting to know these 5 companies in this industry. And then I jump over to this company and suddenly nothing transfers, or very little transfers, because it has a whole bunch of different things that I got to know. And this company over here, I don't even understand half of what's going on there. And it just seemed, how do you even know all of this stuff? Every company has its own unique characteristics that you got to know. And you find yourself learning as fast as you can, but every day you get sideswiped by information where you go, I didn't even know I had to pay attention to that. Well, now I got to pay attention to that because it just showed up. You'll never know it all. Well, I then came across technical analysis, and technical analysis gave you a chart, and every company has a chart, and it gave you some price action, and it gave you volume. And I thought, every company has price and volume. I don't have to learn about company ABC and what drives that, and company XYZ and what drives that. They both have charts, they both have price, they both have volume. Well, this makes it a lot easier because now I can look at almost every stock by looking at price and volume. So when I first got into technical analysis, I thought, this is so refreshing. And I absorbed everything I possibly could. I ignored everything else. I said, why even bother? This is Valhalla. This is the answer. This generalizes across everything. I don't care about what this company does and what that company does and what that company. It would take me months to figure it out. I already got this figured out and it applies to everything. So when I first got into technical analysis, it was momentum. And it was the time when the momentum factor was in favor, so up it was going. So I was using technical analysis, momentum following, and making money and thinking, there we go. I was trading some names. I didn't even know what the hell they did. But I was unaware at the time that there was such a risk factor called momentum that you could look at fundamentally. I was unaware of it. It just so happened that I picked a factor that happened to be in favor, and I confused luck for brains. And I thought I was really doing something until momentum broke and momentum went away. Then all of a sudden, I was 50-50. Technical analysis suddenly was 50-50. That sometimes an indicator worked, sometimes it didn't. Whereas before, when I was momentum following, it was 90 to 95% of the time I was right. And it was great. It was like, this is so easy. And then it broke. And then you're 50-50. So then you start thinking about it, and after a while you reject certain things. And in the end, I rejected quite a few things of technical analysis once I started paying attention to not just the good stuff, but now you're paying attention to the negative stuff about technical analysis, and you start reading papers and academic papers finding that there is no excess performance or excess return that can be found academically when investigating technical analysis. Well, when you're in love with something, you ignore the bad stuff. That's called confirmation bias, and I suffered from confirmation bias at the time because it was working, so you couldn't tell me that it was garbage because it was working. Well, you come to your own conclusions about what works and what doesn't. I have accepted and rejected over time a lot of indicators. So I can't say to you, here are the ones to look for. Nothing else matters, because you are not doing the same thing I'm doing. You don't see the world the same way I do. You don't have the same motivations I do. You don't have the same strategy, the same style that I do. There just is no one list. That's a long answer to your question, but I hope it helps. Okay, these next two questions go together. Q&A, could you show how to figure out what percentage move your straddle implies? And that's followed by, instead of a straddle, wouldn't it make more sense to do a debit iron butterfly? If at 366 the move implied by the market is 3.5, selling a call and put at a move of 4.5, it should somewhat lower the cost of a straddle. Yeah, it does lower the cost of a straddle, but it also lowers your profit as well. It lowers your break-even points, but it lowers your profit, right? So let's first answer the first one. It's 11 a.m. When I did this, October 12th. The SPY is sitting at 358.05, which is nice because we can do the 358 straddle without a lot of intrinsic value in one of the options pushing us around. 1065. So if you take 1065 and you divide it by the price, you get 2.975. That's how you calculate the implied move. So it's going to cost you $10.65 to put on this bet. The index, the ETF is sitting at 358. Your break even is going to be 358 minus the 1065 because you paid 1065. So the market has to move by more than that. So it's got to get either to 347.35 or 368.65. Well, that is down 3% and that is up 3%. So that's what we mean by an implied move of 2.975. It's a move of 3% in one direction or the other. You just don't know what direction it's going to go in. That's why you do a straddle. The second part was, well, instead of paying 1065, can we get this down? If it's going to move 3%, why don't we do something at these break-even points? Or further, if the first break-even point is 347, you can go even lower than that, or you can go higher than this. I just said, okay, well, let's go down 3% and up 3. And sell some premium there, which means we'll make that premium. So 347, 369. We can get our straddle price down to 775 by doing that. If you divide it by the 358.05, now we only need a 2.16% move to hit our break even. And there's our break even points. So our first break even is at 350, and we can make everything from 350 down to 347. So if it drops past 350 and keeps going from 350.22 down to 347, that belongs to us. If it goes up anything past 365.78 all the way to 369, we make money. Our maximum return is $322. And that's the most that we can make. The most we can make is unlimited, because once it gets past let's say 347.35, the lower it goes, we continue making money. But it's got to get to 347.35 for us to break even. Here it only has to get to 350.22 to break even. I should note that both of these numbers are below the current market low right now. So yeah, you can do that. You can go out further. You can say, well, I'm not going to use 347. I'll use 345 and I'll use 371, which means that it won't be 775. It'll be something higher than 775. Your max return will be higher, but your break evens will be wider apart. Again, it's whatever you feel. It's whatever you feel comfortable doing. Okay, 2 follow-up questions. Hope you could share your thoughts. I've read this a couple of times. I'm not quite sure what the question is, but I'll do the best I can here. I'm wondering, based on your experiences, normally how long would the real market or economy be affected by Fed monetary policy of rate changes or rate increases? How long would it be affected by? Well, for as long as it keeps it at that level, it will be affected. The economy is always affected by where rates are. So I'm not too sure what you mean by how long would the real market economy be affected by rate changes. If the Fed keeps rates where they are, there will be an effect on the economy. If it lowers rates, there'll be an effect. So maybe your question is more in lines of how long does a rate increase take to find its way into the economy, and that depends on what sector or what part you're looking at. Some rate changes have immediate effects. So when the Bank of Canada raised rates last time, the 6 major banks raised their mortgage rate and their prime lending rate in lockstep. And then about a couple of weeks later, they then raised their deposit rate. Very quick to raise the rate on the interest they charge, but much slower to raise the interest rate on the interest that they pay. So how it works its way into the economy depends on what kind of decisions are being made. If you want to learn more about the effect of the interest rate on the sector of the economy, I'm not going to go into it, but you can Google Hayekian triangle. You can Google the Hayekian triangle, and it's more from an Austrian perspective, and that has some interesting things to say. With U.S. Reserve hold by foreign central banks is dropping back to 2012-2019 average level. And with 2020-2021 Fed balance sheet increase, what is your thoughts on how long Fed will continue holding on their rate increase hiking? I don't know so much that that they're going to be too concerned with this, because they can always open a swap line if that's the case. So I don't know that they're going to see the interest rate as a way to deal with that. They can always open swap lines without doing anything to interest rates. As far as the balance sheet increase, well, we have balance sheet runoff right now, which is holding the money supply constant at this point. It may begin to drop the money supply at some point, but this is actually an accelerant for deflation, which is what they want. So it actually can get us there faster. Will it have an interaction effect with rate increases and lead to deflation? In other words, not just a 2% rate, but inflation below 0%, where suddenly you have a big problem where you can't fix this. Given technology today, given the rapid pace of technology is deflationary to begin with because it leads to productivity gains. So I'll explain productivity gains here with a simple example. Let's say you have a machine and you have a person working on that particular machine, and this machine can produce 10 units of output. And you currently have a supply constraints such that it can now only produce 5 units of output. The cost of this machine, the cost of this labor are the same whether you produce 10 or 5. The only difference is the raw material to produce the 5. So what happens is your costs go up because productivity drops, because now you're only making 5. If the supply constraint fixes itself and you can now produce 10, well, again, all these costs are the same whether you produce 5 or 10. The only difference is the variable costs. Your cost per unit drops. That's called productivity. If your cost per unit is increasing, you have decreasing productivity. That is inflationary. If you have decreasing costs per unit, that is deflationary. We live in a technologically and capital-driven world for the most part. So, the idea that we are going through an inflationary period against a backdrop of deflation, I think, is a true statement. It's just you got to get this inflation out of the system, or at least the central banks believe you got to get inflation out of the system. If it were a fair race between technology and the central bank, by a fair race, I mean that the cost of capital for technology would not increase. It would be held constant, but the Fed would raise rates and the cost of capital for everybody else would go up. In a fair race, technology would win. Technology is what is deflationary, not higher interest rates. Technology is deflationary far more effectively and faster than raising interest rates could ever be. But as you raise interest rates, you lower the motivation for investment in technology, right? So it seems to me there should be some fiscal policy saying, we will be the lender to tech firms that can show that they can increase automation, increase AI, reduce labor costs, any of that kind of stuff. But in a fair race, The free market will always beat intervention. Always beat intervention. Okay, next one. The way I understand your explanation of the decreasing velocity of money, it seems problems that M2 is not finding its way into GDP. That is correct. Who would be holding on to the money in their pocket in this scenario? The Fed. The Fed is holding on to it. If a typical person spends that money, it will show up in C. Yes, it will. And if they put this into a savings account, it would show up in I. Well, you think it would show up in I. I put my money into a bank. The bank then lends that money out, but what if there are no lenders? The bank has extra cash. Well, what's the bank going to do with that cash? It's going to try to park it in some Treasury securities. Well, what if it can't find any Treasury securities because the Treasury is just not issuing enough securities for everybody for all these banks who have extra cash? If they try to lend this money to another bank, the other bank says, I got cash. Everyone's got cash. Well, no one's going to pay any interest on cash. So what's going to happen to short rates, especially the overnight rate? Overnight rate is going to drop. Fed says, no, no, no. We need the overnight rate to go up because all other rates are set off the overnight rate. So I'll tell you what. You got extra cash. You come to me. We'll do a reverse repo. I'll give you 3% on your money. So it will borrow at 3 and it will lend at 3.25. That's how it targets the overnight rate with open market operations. So it's going to do reverse repos and it's going to give the bank that 3%. That money has no velocity. That is money in your pocket. It is their central bank reserves basically. So it's just in that particular market. The reverse repo market right now is what, $2.5 trillion. That's how much money has not found its way into GDP because the banks aren't lending it out. People who put their money in the bank aren't spending it. The bank's not spending it. It's not investment. Whenever it's given this way for through repos and reverse repos, well, reverse repos primarily, that is the same as putting the money in your pocket. It's not finding its way into GDP. So all of that money that's just sitting around doing nothing aggregates its way all the way up to the banks who say we got money to lend overnight. There's nothing to put money into that can give us any kind of interest rate, but the Fed's giving away 3%. Let's give our money to the Fed. Considering the relative inactivity in IPOs and the inverted yield curve hurting net income margin, do you think a weak quarter of earnings is priced in for the results on Friday? I think the expectations are priced in. The expectations are for negative year over year. I think those are mostly priced in. I say mostly priced in. You never know if it's completely priced in, overpriced, underpriced. But if it's known information, if guidance is known and the state of the yield curve is known, the state of the IPO market is known, the state of issuance is known, then yeah, bank analysts would have incorporated that into their forecasts. The consensus forecast, which is the sum of all the banking analysts, you know, the wisdom of the crowd notion, that would be known information, and I think the market is positioned for it. Also, when you divide net interest income by the bank's assets, do you get net interest margin? Yes, you do. Net income margin. No. Net income margin is you have your interest income minus your interest expense minus all of your overhead, management expenses, rent, utilities, all of that kind of stuff comes after net income as a bottom line number. A question about levels on SPY. I noticed different charting platforms show either adjusted or non-adjusted prices, leading to pretty stark differences in the historical chart. SPY's pre-pandemic highs around 338 non-adjusted and 326 adjusted. Do you think this has implications for how SPY responds to certain levels? Well, it depends on what you're charting. Are you charting a price return or total return? If you're charting a price return, most charting software and platforms will already adjust that chart for splits and things like that. Dividends just have a price drop. You don't adjust a chart for dividends. The price on the ex-dividend date just drops by the amount of the dividend. So if you're looking at charting, you're going to want, and if you're not interested in returns, you're just looking at the price itself, not total return, not the reinvestment of the dividend, because you don't necessarily have to reinvest in the very thing that you own. You want a price history or to a chart based on the price return only. The mortgage 30-year spread against the 30-year Treasury is higher than the spread observed in 2000, 2008. I'd have a question as to why we would use the 30-year Treasury here. If you're saying, well, this is 30 years, shouldn't we use a 30-year? It has different duration and different payment schedules. This is a mortgage is what's called fully amortizing, and this is what's called a bullet bond, meaning you get coupon, 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 and then principal. Here you get interest plus principal, so that by the time you get the last payment, you're owed zero. Here, by the time you get your last coupon, all your principal is outstanding. So because all the weight is at the very end, the duration is pulled forward. Because you're getting principal again and again, the duration is pulled inwards, so that a more relevant Treasury to use would be the 10-year. It is a level comparable to June 86. Why this spread has increased way more than the OS for corporate bonds. Could we see a good entry point with ETF, agency, REIT? I don't know that. Well, first of all, I wouldn't use the 30-year. I'd use the 10-year. Let's have a look at those. Okay, so this is the spread on the 30-year fixed rate mortgage, the 30-year constant maturity. I've just used Fred for this because it has a nice history. You can see where we are here at almost 298 basis points is the highest, going past 2000. And if you scroll it back, let's keep going back, 85. Keep going back further. We were at what, 300 basis points here. Yeah, you'd have to go back to 1986 to get those particular spreads. If you look at them separately, we just looked at the spread between them. This is the absolute levels. If we look at where the 30-year is today, and we go back to this period of time before the recession, the 30-year was a good 100 basis points higher. And the mortgage rate was pretty much at the same level it is now. We have what, 6.66 here. Back here you had as high as 6.42. This was 6.8. So it was the same level, just the 30-year Treasury was higher at that time. So again, the 30-year has a very different duration than a 30-year MBS, because the 30-year MBS is well, it has different convexity as well, right? So you have much lower duration with negative convexity. A 10-year is probably a better one to look at, and this is the spread with the 30-year fixed rate against the 10-year, which would have a much more comparable duration. And here we are at this point in time here, 2.91. But notice that it's not out of line. If you go back to the early 80s, it's quite high, but it's in line with what we have in 2000. We can zoom into that area there. So here was the peak of it, 2.9725, and we are currently at 2.918. And just after the pandemic here, we were as high as 2.6. So it's not too far out of line. It spends some time going up, but then comes down very quickly. So it depends on when the Fed signals that it's going to stop. And at that point, the mortgage rate can find a home. And it probably find a home somewhere lower in anticipation that rates will stabilize at that level and then come down as opposed to continue going higher. Okay, thank you for the market update. I do have a question. I've been listening to interviews and news on CNBC and Bloomberg, and I hear a lot of experts say that they are tilting their portfolios towards companies with strong free cash flow. May I know what type of free cash flow they are looking at, and in what sectors can we expect strong free cash flow? So how we get to free, this is free cash flow. This is cash flow that is freely available to the company to do whatever it wants, is you can look at cash flow from operations on the cash flow statement and subtract out any CapEx, capital expenditure. This is what is needed to reinvest in the business to continue having the business generate cash. So that is a reinvestment that's necessary. So if that has to be spent, it's spent out of CFO. take that out, and that will be your free cash flow, and you would want that to be positive. It doesn't have to be positive. Some good companies can have positive CFO, but are investing so much in growth that their CFO minus CapEx is negative, so we would expect to see positive cash flow in from cash flow from financing, meaning a debt issue or something to help pay for CapEx. But that is basically what you're looking for over here. Companies with this type of profile with very strong free cash flows tend to have lower growth rates, because if you have very high growth rates, growth costs money, because usually there's a fairly stable return on assets, and if you're growing, well, then you have to continually add assets, otherwise you won't be able to finance, or not finance, you won't be able to get that growth. Growth does cost money. Higher levels of inventory, higher levels of production, more plants, more factories, things like that. So if you're a more stable company and you have a more modest growth rate, you are spitting off cash at that point. So you don't really have to invest in too many assets. Also, scalable businesses are very good. So scalable business can support high levels of growth because they are asset light. So an example of a business that, for the last 15, 20 years was very scalable is something like Facebook. Adding another user doesn't cost anything. It's easy for them to add another user. So scalable businesses can have higher levels of growth and generate higher levels of free cash flow. But typically they're stable businesses. So if you look into the consumer staples sector, you should find a whole bunch of companies that generate very strong free cash flow. But again, you don't have to be a defensive company to generate strong free cash flow. Apple generates very strong free cash flow. And it is a consumer discretionary, a higher beta stock in a sector that's not considered defensive, that's considered cyclical. But you also have to then balance that with, well, is it just strong free cash flow? Is there some forward multiple that makes it a value stock? So is it strong free cash flow in the value sector, or just strong free cash flow? In value sector, that means you're looking for strong free cash flow with low volatility, and that would primarily be utilities, consumer staples, things like that. A few questions in regard to the currency movements. Besides currency appreciation, are there other reasons you decided to go long the peso? I went long the peso because it just, with the strength of the US dollar, the peso outperformed it. So think how strong the peso is. Well, if it's that strong in the face of a strong US dollar, and it's not a reserve currency or a safe haven currency, what's it going to do when the dollar weakens? And I don't know when the dollar is going to weaken, but it seems to me like it's going to take off like a rocket. It seems to me like it's going to do very, very well because it's held up so good in front of the strength that when that thing weakens, I can't make an argument for why the peso would be stronger than the US given what we have. Other than there must be some inflows into the peso supporting that strength. Longer term strategic investments, I think so. I think longer term the peso will do very well, but if I think longer term the peso is going to do very well, I also have a belief that their equity markets are going to do very well. It's just not time to buy the equity markets in Mexico yet. Also, I know this may seem crazy, but the US euro is down 15% year to date. Obviously, there are a lot of unknowns in that region, but wouldn't it be wise to start building a longer-term position there and wait for the currency to revert to the mean? Well, a currency, when we say currency reverting to the mean, we have to sort of pick out what time frame we're looking at, because it could take 10 years for that to happen. Some currencies have very long cycles. The US can't continue to strengthen at this speed. One thing I've learned in markets to be aware of is that high prices can go higher and lower prices can go lower. So I'm curious as to when the best shift from the US into something else. How I would think about this is the euro is really cheap to buy right now. The US is very, very strong. So buying companies in Europe right now is super cheap to do. So find some companies in Europe that you think would do very well when this is all over, and you can you can buy into those. And you'll be buying that company cheaper in US dollars than what you otherwise could. If the euro strengthens and the company doesn't, well, you'll do okay. If the company strengthens and the euro doesn't, well, then you'll get a return. But if the euro strengthens and the company strengthens at the same time, you'll do okay. And you're right, you're never going to pick a bottom. So if you think the US strength is kind of topping out and doesn't have much more to go, but you think, well, I don't think this is the top. I don't think it's going to turn around tomorrow. I just don't see that much upside, and I don't know when it's going to turn around. That if the US dollar is doing this, you think, and the euro is doing this, well, you're never going to pick this point and this point. That sometimes it might be better to say, okay, well, let's get a little bit here. Let's get a little bit more over here. We'll grab some over here, and when we see this dropping off, then I'm going to lean into this. You lean in when you actually have confirmation that something is moving in that direction, that something significant has changed. In the meantime, sit in something that is paying a dividend. I think euro companies pay a dividend every 6 months, not every quarter, or is it every year that they pay their dividend? I don't know, but BMW is sitting on a big fat dividend. Volkswagen, I think, looks good. That's just in the car sector, but you can find other companies that you find interesting as well, but that's how I would do it. I don't know that I would go into any European bonds at this point because they've just started their rate hiking cycle, which means based on duration, you buy bonds, you're going to lose market value. What if you want to take that money out, right? So start stock picking, see what you get. Okay, first question. I had one question when buying put options. Buying. I don't know that I suggested buying, but okay, when buying, how do you decide which strike price and expiration to choose, especially when I wouldn't wait until expiration to close the options? When you're buying, there are two ways to do it: very short, or very long. That's it, very short or very long. Very short, because you expect something to happen in that particular window. So if you're buying very short, you're basically buying event risk. So the CPI report tomorrow morning at 8:30, that's event risk. The market is either going to move one direction or another direction. You just don't know which one, so you buy a call, you buy a put, or if you think, well, the market's really going to sell off on it, it's going to come in hot, you buy a put. And you want the shortest amount of time because you're buying event risk. If you're just saying, oh, I think the market is going to go down, buy very long periods of time. So if you say, well, I think over the next 2 months the market is going to drop, then buy a 6-month put and close it out in 4 months. Reason is theta decays like this. And there's the last 30 days. So there's very little theta decay in going from a 6-month to a 4-month, but there's a lot of theta decay in a 2-month option if your horizon is 2 months. So buy a 6-month and close it out in 4 months. This is if you expect a directional move, but if you're betting on event risk, then you want to put your options as close to the event as possible. Let's see, thanks for your continue. Throughout the year, you've mentioned the inversion of the yield curve. In the video of the 30th of July, you mentioned that, of course, every recession is being preceded by an inverted yield curve. You've also mentioned that the yield curve steepens again before a recession has actually occurred. Well, it steepens before the recession is over. It precedes an inverted yield curve precedes a recession by 2 to 3 quarters. The steepening of the curve can happen with the long end of the curve just rising without the short end of the curve dropping. So it can steepen in that particular sense without levels dropping. But typically what happens is a central bank may be on hold in front of weakening data, and especially if inflation is going down, we'll expect the central bank to be on hold. The front end of the curve will start dropping before a recession is actually declared, but that it's clear from the economic data that we're in one. Once the Fed starts cutting rates, the yield curve steepens very quickly and get very steep well before the end of the recession. So where are we? My question is, if the Fed has the motto of higher for longer, one way of steepening the curve is to raise 10-year yields. as no rate cuts on the 2-year will therefore be expected. How far ahead does the market look in terms of 10-year pricing to look past a possible recession? Well, the market tries to discount all of the future. It doesn't just look ahead, it tries to discount all of the future. But it also has to discount the short end of the curve as well. It also has to figure out what's going on the short end. So I don't know that I would say, when we say that something is priced in 2 to 3 quarters out, that's a particular event that we're looking at. But when we say, how does the 10-year price in anything? It'll price in all 10 years of cash flow based on what its expectations are for the yield curve over that period of time and inflation. Most of that can be done with yield curve models that tell you whether, it's all just a forecast, right? So, when we look at the 10-year yield, that's the yield over the next 10 years. That is the market's best guess as to what the break-even rate of inflation would be and how much we want to be compensated based on an inflation component versus a real component. We're more than 90 days inverted now. Is there any rule we can exactly use to approximate when the recession will actually materialize? Not really. Not really. It is a probability of a recession that an inverted yield curve is sort of giving us, and the probabilities increase with depth and duration. The deeper the inversion and the longer the inversion, the higher the probability of a recession, because it does change behavior. It does change investment behavior. It changes financing decisions. It does cause dislocations in markets that reduce the level of employment and reduce the level of investment. So it is sort of it does have some causal effect, not just prediction effect. But again, it depends on depth and duration. The deeper and the longer, the more likely it is. That's about it. There is no actual prediction. If there was a prediction, if we could predict everything, we wouldn't need people. Algorithms would run the whole world if we could predict with accuracy. But there is always uncertainty, and I don't know that any AI or algorithm yet has developed intuition, other than just there's that feeling you get that just comes with experience, So I don't know if I answered the question, but there it is. Okay, 3 questions. In the last Q&A, you talked about how we shouldn't risk more than 500 daily on theta. That's not quite what I said. And somebody answered this, and I think they answered it well, but I'll just answer it for everyone. Is that amount per stock or more on portfolio level? More generally, could you give some general guidelines on risk allocation across different risk factors? So for theta, let's say you have a $50,000 portfolio, and you're not very adept at options yet. So you might want to go with let's say 0.5% per day in theta income. That would be $250 a day. So let's say you look at a particular option, a 16 delta option, and it has a theta of, let's say, 1.2. That is per option. That means that's $12. And this is the theta per day. That's $12 per contract. So you take off 12, you're at 238. So you sell that one. Okay, you can keep looking around until you fill up your budget of 250 based on what your theta decay per day is. Once you get to that point, you're done. Now what happens is, as you get closer to expiration, these thetas increase, which means you'll increase past the 250, which gives you a signal that you need to reduce your exposure down to 250 by closing out some of these options before expiration. And by doing that, you close out the ones that are closest to the strike price, perhaps, and then you could reduce your gamma risk. That's what theta. That's what I meant when I said theta decay. Now that's 0.5. That's small. You can manage that without getting into too much trouble. Just in case things go wrong and things get assigned to you, you can absorb them. Once you get better at it and you're doing well, you can move from 0.5 to 0.6, from 0.6 to 0.7. You can eventually get to 1% or 1.5%. 2%, you're pushing it. You're living on the edge that you better be ready to to adjust your portfolio very quickly. And that is theta decay per day, right? What's your opinion on systematic trend following strategies on futures? You could offer some uncorrelated returns to the stock market. Yeah, well, okay, so it can give you uncorrelated returns, but just because it's uncorrelated doesn't necessarily mean it'll be positive, right? It depends on the futures. What futures are you following? If it's, you know, futures on the market, then no, you don't have any uncorrelated strategy at all. But sure, you can find sources of alpha. Alpha is returns that are uncorrelated with the market as a whole, but you still have to know how to generate positive alpha. So that's about as far as I can go on that without knowing what it is that you want to do. But your trend following, most trend following on futures tends to be long futures in backwardation. The problem with backwardation is if it flips into contango, it's not the long end of the curve that changes, it's the short end of the curve that drops like this. So it, you know, if it was in backwardation, it drops significantly down here. So, you know, that stuff works well until it doesn't work. Momentum is your friend until the end, and then it's done. And if you're trend following, there is some element of momentum there. In IB, margin requirement when shorting calls is not linearly related to the number of contracts. It is. When shorting one call, I need 300. When I try to short two instead of one, I need 3,000. Well, hang on. When shorting one call, you need 300. That could be just the premium that you've taken, but there might be another security. Maybe you're long the shares and you sold a call on the shares. Then let's say it was you're long 100 shares and you sold a call. Then you need that premium. But if you sell two, well, then you have a covered call and then you're short one call. So the margin you're getting here is for being short one call, whereas this over here could be to cover the long position you have. Or you could be short another option. You could be short a put, and then you're going to short a call. Well, the stock can't be in two places at the same time, so only one margin would apply. So this call here would say, well, if you short the put and you short the call, you've already put up margin, and since the stock price cannot be in two places at the same time, only one of these are going to be at risk at any given time, so that one margin would cover both. And then when you have the second call, since you don't have another option to offset it, then you have the full margin on that. But the margin is linear related. If you have a zero portfolio, brand new portfolio, nothing in it, every option you add, you will have a linear relationship with your margin. Unless you have other securities in your portfolio that when you sell a call, it says, oh, well, since you have this other one, you already had margin on this other one, which covers you on this one. So without knowing what it is you're doing and what it is you're holding, I can't answer that question completely. And that does it. 1:07 p.m. We got Fed minutes in 53 minutes. And then 2 hours after that, we close for the day. And then it's CPI. So by 4 o'clock, if, you know, position yourself. Well, actually, you probably won't even hear this before 4 o'clock. So let's just leave it at that.